Welcome to The Explainer. Today, we're diving deep into a really bold argument for the future of silver. It's a fascinating case that's built on history, some pretty wild industrial demand, and numbers that will definitely make you look twice.
So, the analysis we're looking at today kicks off with this really provocative claim. The idea is that the current price of silver, far from being expensive, might actually be a massive historical bargain. It's a huge statement, so let's see how they back it up.
And there it is. The number that grabs all the headlines, $700. I know, it sounds pretty extreme, right? So let's really unpack how the author even gets to a number like that, step by step.
To really get this argument, we have to start with the context. The source points out that back in early 2026, silver rocketed to a record high of over $121, and then, boom, it crashed 44% down to $67. Now it's kind of floating around that $80 mark. So, how does a bull case even survive that kind of crazy volatility?
Okay, so here's the core thesis, and this is really important. The analysis argues that crash had nothing to do with the physical metal. Not at all. It was a financial event, driven by algorithms and paper contracts, totally disconnected from what's happening with real-world supply and demand. And this slide just lays out that central conflict perfectly. You've got the super volatile paper market on one side, driven by finance. And then on the other, you have the physical market, where real, actual demand is just eating up supply. The whole argument is that these two markets are telling completely opposite stories right now. The entire case really hinges on this one concept, a structural deficit. And the key word here is structural. This isn't just a one-off thing, it's a persistent long-term problem where the world is physically using more silver than it's pulling out of the ground. And this imbalance, well, it's been going on for a while. According to the Silver Institute data that the source uses, 2026 is the 6th year in a row of this deficit. That means those big above-ground stockpiles are just getting drained year after year to fill that gap. So what is causing all this demand? Where is it coming from? The analysis points to 3 huge industrial drivers that it says are basically irreversible. They're creating this solid floor of consumption that just keeps growing. Now, what's so important to understand here is this idea of price-insensitive demand. Think about it. For things like solar panels, EVs, and AI data centers, silver is absolutely critical, but it's a tiny, tiny piece of the total cost. The argument is that these industries, they're going to buy the silver they need no matter what it costs. And this projection really shows you the future. I mean, look at this. The source highlights that the auto sector, thanks to the whole EV revolution, is on track to become the single biggest consumer of industrial silver. And that's supposed to happen within the next decade.
Okay, let's switch gears and talk about history, because the analysis argues that we've kind of seen this movie before, that past performance in similar economic setups gives us a pretty good clue about what could be coming next.
The source draws these direct lines between the macro environment of the 1970s and the period right after 2008. Things like high inflation, energy shocks, and central banks printing money. The argument is that the setup today looks an awful lot like it did back then. All right, now for the part you've been waiting for. Let's get into the math. How on earth do we get from a choppy $80 price today to those huge headline-grabbing numbers? So the case is built in 3 very distinct layers. They don't just jump to the big number. Each scenario adds a new, bigger variable into the mix, starting with a pretty conservative view and building up to that perfect storm outcome. So this first scenario, the conservative one, it only relies on 2 big assumptions. First, that gold hits a higher price, something a lot of mainstream analysts are already talking about. And second, that the gold to silver ratio just goes back to its historical average. Just based on that, the math spits out a silver price somewhere between $150 and $200. Now, the second layer, this is where we start talking about much bigger forces. This scenario assumes that the U.S. national debt, which the source cites as over $38 trillion, starts to really shake global confidence. If that happens, the dollar's buying power drops, and that would force a repricing of all hard assets, like silver, to much, much higher prices. And the source uses this pretty cool thought experiment to put those numbers in perspective. It's not a prediction, right? But it's a mathematical exercise. It shows that if this current cycle were to just match the same percentage gains as the 1970s bull market, well, that alone would imply a price right in the middle of the second scenario's range. And that brings us to the final and, the most speculative scenario. What happens if everything goes right for silver all at the same time? This is where the analysis says you'd need a perfect storm, a convergence of multiple crises at once. So this extreme outcome is basically presented as what happens if four things all hit at the same time. A real crisis of confidence in the dollar, a physical supply squeeze that makes industries start hoarding the metal, the Fed having to print money while the economy is in a recession, and all the geopolitical chaos just continuing. Okay, but to keep things balanced, the analysis is not just a one-sided bullhorn. It's actually very clear about the potential downsides and just how crazy this market can be. And the really crucial takeaway from this section is that the source stresses over and over again. This is a long-term thesis, not a short-term trade. It means you'd have to handle some absolutely insane volatility, and you have to accept that the whole macro picture could shift against this idea at any moment. So, to wrap it all up, what's the big takeaway? The core argument is pretty straightforward. The short-term financial noise is making everyone miss the bigger story, which is the long-term physical reality of a supply deficit and demand that just won't quit.
And in the end, the analysis leaves us with this final, really thought-provoking question. It reframes the current price not just as a number, but as a decision point. Is $80 the price you see before all these major macro shifts really play out? Or is it a sign that the big move has already been missed? According to this analysis, that could be one of the most important financial questions of the next decade.